Given that the drop in yields was fairly fleeting, we've seen them come right back, the round trip, do we presume that this increased buyback announcement is the start of something more, that this could be like a new regime?
Well, if it's not the start of something more, then we're simply going to see longer dated yields drift higher. Now, there's a conversation to be had about whether or not the size of 20 and 30-year auctions are too large in this environment. Not necessarily our call, but I wouldn't be surprised to see that idea get a little bit of traction after Bessent's move this week, simply because, as Jonathan pointed out, we're seeing a lot of non-conventional tools used to address this problem. And at the end of the day, it is a fundamental problem. It is a global issuance problem, and it's become an elevated real 30-year problem, which I think adds an interesting nuance at this point.
Stephanie, what do you think?
I think the fundamental issues have to be addressed to some extent, right? Like, of course, the Treasury can try to step in and address some of the supply-demand issues, but the problem realistically is a Fed that we don't really understand the reaction function, the data which have been hot. Our expectation is that you'll see the dynamics actually change from an economic perspective into the future, and therefore you actually get a little bit of relief from Treasury yields, but it's not really Treasury's issue to solve. So our expectation is that, certainly yesterday the move was too big. Now markets have certainly reversed that. We don't think there's a whole lot that Bessent can really do. It's really a matter of some of the other drivers that have to change in order for rates to come down.